Okay, good morning and welcome back everyone to our Tuesday morning market outlook session. My name is Tony Zhang. I'm the chief strategist here at Options Play. And we are kicking off this week with equity markets on a very bullish tone here, a very optimistic tone here on the back of what was um, Friday's inflation print that largely secured a rate cut here for the month of October, which is tomorrow. And potentially even more importantly than that, the softer than expected inflation largely reinforced the potential for two rate cuts by the end of this year. So seeing a rate cut here for October and then another one for December really opened up the possibility of that with inflation coming in softer than expected. And then you add on top of that the what seems like a much more positive rhetoric out of China with regards to the trade deal with the US yesterday, or rather over the weekend. It kind of boosted the optimism for equities going into yesterday's open, and we saw that strength carry through yesterday's session. Uh, we continue to see 10-year yields remain fairly constructive here in that supports the equity markets that we currently find ourselves in. And then you have the just overall, you have the um, earning season so far that has been quite positive here for US corporate earnings that has continued to provide further upside, or rather optimism here for the markets. The one thing I do think for investors it's important to understand is just that, if you look at the S&P right now, we're trading at nearly 23 times forward earnings, which is quite high here if you look at historical averages for valuations. So the recent breakout here that we've seen on the S&P 500, if you look at kind of the fact that we've been sort of trading range bound for nearly a month here for the S&P, while just breaking out here the last couple of days, that breakout here in itself is a bullish signal here, but we are starting to get pretty long here in terms of from a valuation perspective and also from a technical perspective, getting to what we would consider as classically overbought conditions, um, especially when you look at the underlying reason as to why the Federal Reserve is on a trajectory to cut rates potentially two more times before the end of the year, which is really based on the fact that the labor market continues to slow down fairly significantly. The expectation is that the US economy has already decelerated by a significant portion and has the propensity to potentially weaken further. And that's why the Federal Reserve has to uh, cut interest rates for October and potentially again here for December. So I think it's really important to understand the fundamental or economic backdrop that's driving the need to cut interest rates is not particularly good for the US economy. And we need to factor that into our views as far as how much higher can equities move. Now, this week is big week for the Magnificent Seven. You have Microsoft, Alphabet, Meta, Apple, and Amazon all set to report um, just in this week alone. And we've already seen some news yesterday with Amazon expecting to reduce a significant amount of headcount. The expectation is that the Magnificent Seven has the potential of moving the sentiment of markets because a lot of kind of AI driven hype is installed into these specific names, and any changes in investor sentiment, in investor mindset as far as the trajectory of AI is, embedded in some of these names that are reporting this particular week. So I think that those are some of the things that are really important to pay attention to here in the US equity markets. So as we said, as we were looking at this before, if you look at the S&P 500, we've been on this very significant tear here to the upside. But over the last month here, the equity markets have largely been range bound. And now we recently, over the last couple of trading sessions, just got that breakout here to the upside. We see that on both the S&P 500 as well as in the NASDAQ 100. If you look at the Qs, see the same thing here for the Qs, recently breaking out above that 610 level here to the upside after what has been a bit of a range bound market here for the last, call it 4 weeks or so, breaking out here to the upside. That's a fairly, I would say, bullish signal here that we're getting here from the US equity markets. You see it on um, the major cap indices. If you look at IWM small caps, note that even despite yesterday's move here, we still remain below the all-time highs here. So small caps so far has not confirmed the new all-time highs that we've seen on the S&P 500 and on the NASDAQ 100. And if you look at RSP, the equal weight S&P 500, we're just barely getting to a new all-time high yesterday, also moving higher, but not quite decisively breaking out higher here. And what that's showing me is that, well, while we have this breakout here to the upside on the S&P and the NASDAQ 100, that is largely starting to be driven off of large cap growth rather than being driven by the broader equity markets, meaning broader participation in this move here has not been as strong as perhaps we would like to see. If you, but if you look at kind of positioning, things certainly look a lot more offensive from a positioning perspective. You look at what sectors are outperforming, technology, discretionary, energy, are outperforming while consumer staples, utilities, real estate are sort of lagging behind. So positioning has kind of shifted back towards a much more offensive tone here, but the participation right now here is not quite all there just yet. Now, we could see that play a little bit of catch up here over the next couple of trading sessions. That very well could be how this plays out. Look at HYG. You see that high yield corporate bonds recently broke out to new all-time highs as well, confirming the risk on signal here that we've gotten here from equities. And then if you look at TLT, if you look at longer dated bonds, it reflects the fact that over the last last few weeks, we continue to see bond prices move higher here, which correlates with a reduction in bond yields, which is overall a positive here for the US equity markets. But like I said, I think that it's always important to understand the economic backdrop behind equity markets reaching new all-time highs. And when we're seeing unemployment continuing to tick higher, when we're seeing the labor market continue to weaken, and the Federal Reserve having to cut interest rates being the driver of equities making new all-time highs, there's always a little bit of uneasiness and cautiousness that I think we need to apply to how much higher do we think equity markets can go. The momentum clearly is on the side of the bulls at the moment, and that very well could be what drives the markets here over the next few trading weeks, potentially even the next few trading months. But the further that goes along, where the underlying fundamentals look weaker, but the equity markets move higher here, that's when you do start introducing bigger risks here with the broader equity rally here. So those are some of the things that I think if you're an equity investor, you need to be paying attention to here in the market. So let's take a look at kind of where we currently stand here for some ideas here for the week. So a couple of ones that I think are worth paying attention to here right now. Lockheed Martin. This is one that we recently added to our bullish list here. As you can see, it just generated a buy signal here on options play just today. And essentially what we're looking at is sort of this call it this base that Lockheed Martin has been forming here over the last nearly a year, right? This is the stock that's been around this 410, 480 level here for nearly a year now. And it finally just broke out above that level here about a month ago. But now it finally pulled all the way back to that 480 level. And this is really where the risk reward looks incredibly favorable for some upside potential here, meaning your upside potential versus how much you would have to risk if the stock continued to move lower. This ratio of how much upside versus how much downside there is quite attractive here at the moment, because if Lockheed Martin even pulls back to, let's say, 470, 460, 465, that's where I would consider the timing on this incorrect and consider getting out of this particular trade. And then that's risking about, a little over $10 here to the downside. Versus if you look at upside potential here, we're talking north of 550, 560 here. We're talking about a risk reward ratio that's easily 6 to 1, if not 7 to 1 to the upside. And if you look at the fundamentals here, Lockheed Martin's only trading at 16 times forward earnings, which is about a 50% discount to its peers. Now, Lockheed Martin is expected to grow revenues a little bit slower than its peers, and it's slightly not as, and from a profitability perspective, it lags behind its peers slightly. But does that justify a 50% discount relative to its peers? I think that is too big of a discount that it's trading at right now. And that's why the upside potential, I think, looks fairly attractive. And then you align the technicals where the risk reward looks incredibly favorable from where we currently sit. And that's really where I think Lockheed Martin is an interesting bullish opportunity in the markets right now. Next one I want to take a look at here is Gilead. Gilead is call it a pharmaceutical stock that recently has been doing quite well here. Now, Gilead, as you can see, recently also broke out here above a major resistance level here around 120, pulled back to its support level, and that's really where we're looking for a potential bullish entry here for upside. Now, Gilead trades at around 14 times forward earnings, which is in line with the industry. But where Gilead excels relative to its industry is that it's expected to grow EPS at about 3 times the pace of its peers. And profit margin wise, Gilead has around a 22% profit margin versus its industry profit margin averages around 16%. So that's really where Gilead is head and shoulders above its peers and has further upside potential here based on the fact that it's only trading around 14 times forward earnings. The next one I want to take a look at here is PG&E, PCG, Pacific Gas and Electric, a utility company. And this, as you can see, also generated a buy signal here today. This is a bullish trend following buy. Essentially, what we've noticed is a new bullish trend. It's pulled back a little bit within that bullish trend, which presents an opportunity to look for some upside. Now, PCG trades at 10 times forward earnings, which is a pretty significant discount to its peers, which is averaging around 19 times, even though it's expected to grow a little bit slower, both in terms of revenue and profit margins, is around 11% versus 15% for the industry. But that's really where the expectation here for Pacific Gas and Electric is below the industry, but the fact that it trades at a 50% discount, I think, still makes this a compelling trade from a valuation perspective. And I think the timing looks right to look to add some bullish exposure here for Pacific Electric and Gas. Now, Meta reports later this week on tomorrow afternoon, I believe. Meta, I think, represents a very interesting upside opportunity here right now. As you can see, the stock has been kind of range bound between 700 and call it nearly 800 for the last few months. And we're kind of just started to lift off of that bottom here. And I think very easily we're going to target the 800 here to the upside. But earnings could be the catalyst that kind of drives it above 800 here. Now, Meta trades at only 24 times forward earnings, which is, I really think, incredibly cheap if you look at the potential here for Meta from an AI perspective. We're looking at revenue growth that's looking at around 16, 17%. Very few companies are expecting to grow revenues at that pace, especially a company of Meta's size, expected to grow um, revenue, in that 16 to 17% range. But more importantly, Meta, has net margins north of 40%. Very few companies have net margins north of 40%. So you're expected to grow incredibly fast. You're incredibly profitable, yet it only trades at 24 times forward earnings. I think this is, out of all of the Magnificent Sevens, one of the most undervalued ones within that particular space. And within tech overall, Meta is one of the stocks that I'm watching very closely here. And as you can see, trends just started to turn positive here. So this is really potentially early on in capturing what could be a big move here to the upside. The next one I want to take a look at here is Elevance, which is a healthcare insurance company, the second largest behind United Health. And as you can see, the trends here, which was very negative here for quite some time, started to turn positive here. Looked a lot better here, starting to pull back, and we're looking for some further upside here. So we're looking to, we see trends that are starting to look a lot more constructive here. It broke out here above 300, traded sideways here, moved higher, started to pull back a little bit, and we're looking for that pullback as an opportunity to look for some further upside. Now, Elevance trades at around 12 times forward earnings, which is basically in line with kind of health insurance companies at the moment. But Elevance is expected to grow, a little bit faster than its peers. But more importantly, it's more profitable. Its profit margins, like healthcare companies, tend to be on the thinner side, which is why it trades at low multiples. But this is really where Elevance is continuing to improve margins. They've kind of reset expectations for 2025, and they're expecting 2026 to look a lot more healthy from a profit margin perspective. And that's really what presents the upside opportunity here. As you can see, this is a stock, that was trading at $550 a little over a year ago. And that's really kind of where the upside opportunity remains fairly sizable for this particular stock. And then lastly, Alphabet. Alphabet is definitely one of the names that we're paying attention to here right now. Similar to Meta, this is a stock that, even though the stock from a technical perspective looks overbought, from a fundamental perspective, I still think this looks quite inexpensive. It's trading at 24 times forward earnings, which, similar to Meta, we're looking at revenue growth that's in the 12 to 13% range, so a little bit behind Meta from a revenue growth perspective. Profit margins is north of 31%, so also a little bit behind Meta from a profit margin perspective, but trading at 24 times forward earnings remains one of the cheapest names within technology that's growing at that particular pace and is that profitable. There are not many companies that are that profitable like Meta and Alphabet, and most of them are currently not trading anywhere near 24 times forward earnings, which is why, out of all of the big tech names, Meta and Alphabet remain two of my top picks here at the moment. And then I'll leave you with one last bullish opportunity, and that's Micron. Micron is the hard drive or hardware semiconductor manufacturing company that, for a long time, built fairly low tech memory chips. But in the last couple of years, they've recently completely transformed their business in producing high bandwidth memory chips for NVIDIA GPU used in AI training. So Micron is now trading at 13 times forward earnings, which is still, in my opinion, relatively inexpensive. We're expecting revenue growth that's north of 18%, and profit margins actually expanded substantially in just the last 2 quarters, where it was around 18% profit margins. It's now standing at around 23% profit margins. And we're looking to expect that profit margin number to continue to climb here. So the fact that it's only trading at 13 times forward earnings, I think represents one of the more undervalued opportunities in the markets today. And then flipping the coin here, within tech, looking at Apple. If as I look at Alphabet and I look at Meta and I look at those opportunities, Apple represents what I start to see as one of the most overvalued names right now in tech. Now, Apple just made a new all-time high here yesterday. It's trading at around 33 times forward earnings now. Now, just to kind of put a few things into comparison, Meta is expected to grow revenues by about 6%. Compare that to the 12 to 16% that we're expecting from Meta. Apple's expecting to grow revenues much, much slower, yet it trades at a valuation that's nearly 50% higher than Meta and Alphabet. And profit margins are only around 24% compared to 32% and 40% for Alphabet and Meta. So you have a company that's not as profitable, that's growing substantially slower than its peers, yet it trades at a valuation that's nearly 50% higher than, let's say, Meta and Alphabet. So I think Apple at the moment represents one of the most overvalued tech plays within the Magnificent Seven. And Apple reports also, I believe, on Thursday afternoon. And this is really where I start to see some downside risks with companies like Apple trading at 33 times forward earnings, especially when you consider the fact that Apple is arguably falling further behind, both from a hardware perspective and from a software perspective. From an AI perspective, Apple is lagging multiple years behind now its peers. And then within the hardware space, if you look at kind of Vision Pro and the future of AR and VR, this is really where it very much feels like Meta is starting to eat Apple's lunch here. Apple spent over 10 years spending over $100 billion building out kind of their AR product. And it's very clear that Meta's new direction with AR seems to have a much more viable commercial viability compared to the Vision Pro. And that's really where I think that even though it's very early days in the wearable space from a smart glasses perspective, if that category does take off, it very much feels like at the moment Meta is in the lead of that particular category, not Apple, even though arguably Apple's been working on this for much longer and has a much more stronger track record of building great hardware, especially in transformative technologies. And this is one that I think investors need to start paying more attention to, is the fact that if you're an investor in Apple, you are paying a very substantial premium from a valuation perspective, and that comes with some downside risks, I think, in the current market environment that we're in. Another one I want to take a look at here is Dutch Bros. Now, for those of you that live in, let's say, the Southeast, you're probably familiar with Dutch Bros versus not everyone is familiar with this particular company. They are an iced coffee chain company. And as you can see over the last year, this is a stock that has started to underperform here, both the market and its peers. And just the recent rally here represents an opportunity potentially to see some further bearish exposure here. And Dutch Bros is expected to grow quite fast. It's in the category of where we saw Chipotle a few years ago. It's growing both top and bottom line incredibly fast. Or if you look at Kava from a couple of years ago, I would say it's probably a good parallel to what we're seeing here. The recent underperformance is starting to show that investors are a little bit more weary of the fast growth, high valuation names, because Dutch Bros trades at 63 times forward earnings. So it's incredibly expensive. And, when something's growing very fast, you can sort of justify a high valuation. But one of the things that kind of concerns me is the fact that these companies, or Dutch Bros, was just not profitable. profit margins is around 4% versus the industry median is closer around 12, 13%. So the fact that they're far behind from a profitability perspective is really what's concerning to me when it's trading at such rich valuations. And I think the rally that we've seen here in this particular stock is an opportunity for some downside. Next one to take a look at here is Kroger, the supermarket stock. Most of you that live in the US is probably familiar with Kroger's. A similar type similar type play basically here, as you can see, basically since the beginning, sort of the middle of this year, since April, the stock has really gone nowhere. It's been trading sideways while the market has been moving higher. So the relative performance of Kroger continues to disappoint. And then you have this $65 support level here. If it breaks below that level, the downside potential here is quite significant. Now, Kroger is not expensive. It's around 13 times forward earnings, but it also doesn't grow. Expected revenue growth is around 2%, and net margins is under 2%. So it doesn't grow. It's not very profitable, and it's just not the type of business that I think makes a lot of sense to be investing in when the overall economy is continuing to slow down and carries a significant amount of downside risks, in this particular economic environment that we're in. The next one we'll take a look at here is Spotify. Similarly, Spotify to some of the high growth names. This is a stock that you could call this 650 level a pretty important level here. This was prior resistance. That was prior resistance. That's now acting as support here. If the 650 level gets broken here, the downside risk here is closer to around 600, 500 or so. That's kind of our downside target if we break below 650. Spotify trades at 50 times forward earnings. That's double its peers. And to some degree, you can justify that because it's expected to grow very fast. Revenue growth expected is around 17%. That's in the same range as Meta. But where Spotify is very different from some of the names like Meta is the fact that it's just not very profitable. It operates on razor thin margins. We're talking about net margins that are less than profit margins that are less than 5%. So, when companies trade at such rich valuations but have such thin margins, I'm always a little bit weary of those types of stocks in the current market conditions that we find ourselves in. Which is why, as you can see, the stock performance here has been quite poor here. Basically, since June, since June, the stock has continued to move lower here as opposed to move higher alongside with the market. And that's not a good sign heading into the earnings announcements that we are expecting for Spotify next week. And lastly, I'll leave you with here is Caesars. Caesars Entertainment continues to underperform as Las Vegas and online gambling continues to underperform here. Recently just made a new 52-week low, and we're looking for some further downside risks here for Caesars trading at 31 times forward earnings. So with that covers what I wanted to share with you here today. Like I said, the optimism here in the markets is very much in the air. You can feel the momentum here in the broader markets, but especially when things reach this type of overly optimistic tone here, when the underlying fundamentals and economics start to look a little bit weaker, those are some of the signs that you need to be a little bit more cautious going forward, depending on how much higher equity markets move from here. So we'll continue to monitor that and update you every single week. So I hope that you guys find this useful, and I'll see you guys here next week.